U.S. Federal Reserve lowered its overnight borrowing rate to a range of 3.75% to 4%, its second straight interest rate cut. Sam Chai of TD Asset Management here to talk us through the implications. Sam, great to have you here today.
Pleasure to be here, Greg.
That first cut, it was called a risk management cut by the Fed. Are they starting to see with this cut a U.S. economy that needs support from lower rates, or are they still just trying to head off any problems?
I would agree. I think this is a risk management cut by the Fed. And by that, I mean this is the Fed more trying to mitigate potential downside risk, and in particular, trying to risk manage and balance the risk on both sides of the mandate. So just talk a bit more in a bit more details. On the labor market side, core inflation in recent months haven't been picking up. And cumulative inflation pass-through from the tariff side has actually been slightly lower than the Fed expected. So I would say that, while upside inflation risk still remains, it is actually less than feared. On the other hand, for labor market, we didn't get the September non-farm payrolls. Private sector job data signals that the September labor data likely to be slightly continue to be sluggish. And so that downside risk in labor market remains present. So when thinking about that, the upside inflation risk has receded somewhat, while downside labor market risk remains, and that the Fed current policy rate remains restrictive, I think there's good base for the Fed to make a risk management cut today.
When you think about risk management and them not being overly worried about the path forward, I think there was a moment when you and I were watching the press conference with Jerome Powell where he talked about the fact that they're not on a preset course. December is not a done deal. So it seems like they're still willing to take it, meeting by meeting.
Mm-hmm. And I don't find it to be particularly surprising because given that we're in this blackout period right now, right, it's tough for the Fed to pre-commit to a particular path. As we talked about earlier, this is a risk management cut, right? The Fed is not on a preset course to going back to neutral, to cut every meeting to 3%. And so I still think that the base case or the path of least resistance is for December cut to happen. But of course, that is not a done deal, like Chair Powell himself has said.
So without that official government data going forward, and we don't seem to have a timeline for when they're going to start getting again, how is the Fed navigating? How is the Fed assessing the economy right now?
So admittedly, we are in this data fog right now, right? And it's definitely making the Fed's job more challenging. The Fed could be relying on more other type of data. That includes the regional Fed collected data, private sector data, or just their business contacts for qualitative informations. But aside from the federal government data, we still get a variety of other data. For instance, for job market side, we get the JOLTS data. We get state-level initial jobless claim data, which, although not published at the federal level, still give us timely insights into the labor market conditions. On inflation, we got the latest CPI data for September, but we still receive survey of inflation expectation data too. And there's also no shortage of GDP nowcast models, which, for instance, the Atlanta Fed publishes. So all these information help to guide our understanding on the macro factor side. But of course, it's making the Fed's job somewhat more challenging.
Now, they also told us today that, as was expected by the market, they will be ending quantitative tightening. I think it was the beginning of December is what they're aiming for there. In the run-up to that, people started talking about quantitative easing. Is it too quick just to go from the end of QT to start talking about QE?
I think so. I think it is indeed too soon to talk about quantitative easing. I like to think about the Fed changing their policy direction like steering a ship. It's gradual and is measured. But taking a step back as to why the Fed is announcing the end of quantitative tightening today. So looking at indicator from money market, from funding market, we have seen that there's a signal that the U.S. economy possibly have transitioned from the abundant reserve regime, which is how the Fed likes to term it, to now a ample reserve regime. So less abundant. And the Fed likes to still have ample reserve in the economy to ensure liquidity in the financial market, and also the effective transmission mechanism remain in place for policy rates. So the Fed is not looking to shrink their balance sheet further and reduce the reserve level. And hence why they're looking to end the QT program, as you mentioned, at the beginning of December. I do think that for us to see quantitative easing, we need to really be in a place where it's very clear the economy needs more support from the policy in a very timely fashion. and that policy rate is likely not having more room to provide that accommodation. Obviously, that's not the case right now because policy rate remains relatively elevated. And so I think we're still quite some distance away from that.
Now, one more decision before the end of this year. As we head into 2026, we know that Fed Chair Jerome's Powell term is coming to an end. How much should we be concerned about Fed independence?
I think that will be very much still be a theme going to next year. So Chair Powell's term will be ending next May. Months before that, Trump will be appointing the new Fed chair. And needless to say, the White House prefers a new Fed chair who possibly have a much more dovish take on where the monetary policy should be heading versus the current chair. But to the extent that the market can see that the new Fed chair decision may have been more politically motivated rather than purely on economic rationales, this could be eroding the market's confidence in the Fed independence. And more importantly, the Fed's ability to anchor inflation over the long term. The other thing is that earlier next year, we'll have the Supreme Court ruling on Governor Lisa Cook's case. And to the extent that that ruling could be favorable for the White House, that could exacerbate this concern of reduced Fed independence. And just to try to tie it back to the market somewhat, a common way for the market to express this loss of Fed independence theme is by placing a curve steepener bet on the market. In particular, it means that expecting the short end of the interest rate curve to move down on a very dovish Fed. At the same time, the longer end of the interest rate curve could move higher relative to the front end because of the investor being more concerned about long-term inflation and demanding higher term premium. So that will continue to be a theme I think is very interesting to watch next year.
There's a lot there. You broke it down beautifully. How does it all play out for the fixed income markets?
As we discussed earlier, I do still think that the path of least resistance remains to be a cut in December. Of course, that is not a guarantee, that's not a preset course. But I think the burden of the proof is really on the data to prove that another risk management cut is not warranted. I think it's also interesting to talk about, alternative scenario two, right? I think for the Fed to essentially skip a December cut, what they need to see is two things. One, a refirming of labor market, possibly an increase in pace of monthly job gains, and also a deceleration of inflation as well. Because the downside risk to labor market is unlikely to dissipate that quickly in a few months of time. On the other hand, what would be needed for the Fed to deliver a 50 bips cut? Unlikely. But for that, I think the Fed really need to see a major deterioration in labor market data. And in that scenario, inflation may actually come into second place in considerations. So while I think overall the risk reward for fixed income security right now is quite balanced, I think it's important to pay attention to that skew in tail scenarios, and in particular, pay more attention to labor market data.